Well, you know, it all depends on the whole thing pans out. I mean, neither you nor I know that, so we'll have to see to what extent this situation there escalates or whether it gets contained. I mean, I would suspect that there's not in anybody's interest to escalate it any further, but it's really hard to tell how long this could linger on for. And as long as it lingers on, there are of course more uncertainties that would have the usual impact on various market indicators. I mean, so the dollar could get some strength, the gold could also be a safe harbor, etc., right? So, but you know, it's hard to tell where this all will blow. Well, it's not contracting, but it's not really accelerating. But, you know, it was in line with expectations, the 4.7%. That's what we had forecast. It was also what most people, a lot of people in the market had been forecasting. The headline, in some sense, was not a surprise. There were a few surprises if you dig deeper and go beyond the headline numbers. So if you look at the supply side of things, the agricultural sector didn't, you know, deliver as stellarly as we would have expected following the favorable monsoons. So that was a bit of a downside surprise on that front. Manufacturing sector performed more or less in line with expectations as we've seen it from high frequency indicators. The services sector was a positive surprise, I would say. I think the resilience we've seen to some extent in the financial services was a good sign. I was surprised also to some extent to see that the sort of government-related services held up as much as they did, especially in light of the need for fiscal pullback on that side. Similarly, on the demand side, if you look at government consumption, also held up better than expected. It was one of the positive surprises there, as was net exports. On the demand side, however, private consumption and more concerningly, I would say, private investments were the weak spot. If India needs to, for India to come back in some sense and stage sustained recovery, what really needs to have traction on it and move forward is the investment side of things, because that's where the lingering constraints and growth are, and that's where we need to see more progress on that front. Now, I think, as we see it, it's more, I think, a reflection of and move towards having more, should we say, market-determined exchange rate. Somewhat, should we say, more volatility in that fund can therefore, you know, most likely be expected. We don't really see policy changing in the sense that we're now going to see a persistent depreciation of the Chinese currency going forward. Going forward, I think it's still really the policy to have a gradual appreciation over time of the currency. That's really what would help support the rebalancing of growth in China towards external sources of growth, towards more consumption-led growth in the economy. So we believe that's still the underlying policy, but as part of the sort of market orientation of the economy, of the currency, the opening of the capital account, we're likely to see more day-to-day volatility in the currency.